Welcome to the KPC Smart Money Podcast with Kevin and Karen Christ. So this is part 2, Karen, of navigating market volatility. We ran out of time again. Well, we like to keep these to 10, 11 minutes. But we think this is an important topic, especially right now, right?
Yeah.
Because the market's down close to 12%. Last time we looked at S&P 500. And, people are getting nervous. We're talking to people that their 401ks are down 30, 40, 50,000. I talked to one person who's down $100,000 already. No, they have a big 401k.
Well, that makes people very, very nervous, though.
Yes. And so, what we talked about last week is that you have to really decide whether you want to be in the stock market or not. And we've said before, and we'll say it again, our job as advisors really is to manage some money, but also to manage people's emotions and fear and greed.
Well,
right?
And age has a lot to do with your level of concern.
Well, especially if you've already retired or you're getting ready to retire, and after, your 401k's done so well and your IRAs and whatnot, and then all of a sudden you think, well, I want to retire in a year. And my account's down, $50,000.
Right.
Right. And what's going to happen? We got a war in Ukraine. We've got, gas. Gas is going through the roof, $4 a gallon. We've got, people going to the grocery store and a pack of bologna's $5. So it's a good time to be nervous if you're going to be nervous, right? Mm-hmm. And so we have to remember the history. We talked about last week, the global financial crisis of 2008 and terrorist attacks of 9/11. Then we just recently had COVID. Now, the COVID, that was an official bear market, but it only lasted a couple of months.
Yay. It was a V. A
V-shaped recovery. Mm-hmm. Some of you may have heard that in the news. But, what we mentioned was volatility is not new. Between 1950 and 2020, we've had 36 market corrections, which a market correction is a pullback of 10 to 20%. Now, when it gets over 20%, that is a full-blown bear market, right? A sustained 20% loss over a 30-day period, you're in a bear market. Okay, so let's talk about a few markets that weathered the crisis in the past. You talked about, and I talked about, Black Monday in 1987, a 22% drop in one day.
Yep.
I have some guys I play golf with that remember that day very distinctly. Then you had the 1990, 1991. I remember that. That was Iraq invades Kuwait. You had September 11, 2001, the terrorist attacks. There's some kids, that been born that don't remember that. You think about that. Kids that are in college that weren't born when that happened. So,
hey, our kids wouldn't remember that happening.
Well, that's right. So anyway, let's get into timing the market. All right. So timing the market does not work. Someone says, okay, well, look, should we get out now and wait for a while? There were people that got out in 2018 that have stayed out and just never knew when to get back in. And think of what they've missed.
A lot.
Yeah. So you have to decide, what do you want to be in the stock market or not? All right. So the adage of buy low, sell high often leads investors to think they can time the market. But it's nearly impossible to anticipate precisely when investments are at their highest or lowest low. You might be able to achieve it once, but the odds of replicating such success are incredibly slim. Now, let me tell you how I feel about that. All right, so I think with the science today and the algorithms that these really smart people have put together, I don't think jumping in and out of the market works. And last week we mentioned, the Hall of Fame of market timers is an empty room. Mm-hmm. However, I believe there's some third-party money managers that spend their time really, really concentrating on mitigating risk. Mm-hmm. That doesn't mean jumping in and out of the market. It means making subtle adjustments based on technical analysis.
Mhm.
All right. So we don't want to get too technical here, but there are some things you can do, but market timing, jumping in and out, back and forth, does not work. So instead, the more prudent approach is to put time to work for you. Investors who try to avoid volatility by timing the market may miss out on the worst days, but they may also miss out on the best ones. So, Karen, why don't you go through? We've got a little graph here. It shows what $10,000 from 1980. Take us through that, will you?
Sure. So this was an analysis done saying, let's take $10,000, invest it in 1980, and see what happens through all of these events that we have been talking about. If you did nothing, you let it roll, then your 10,000 would have turned into about 650,000. Now, with the second analysis is, okay, let's just say you missed the 5 best days. And those 5 best days are generally comeback days.
Right after the worst days,
They're
right?
almost always right after some of the worst days.
Yeah.
If you missed just 5 since 1980, then instead of having 650,000, you'd have a little over 400. That is because of time and growth.
Yeah.
You missed almost 250,000. And this graph goes to what happens if you miss 10, what happens if you miss 30. Now, since 1980, if you just missed 30 of the best days because you were trying to time the market, you would have about $130,000 instead of 640.
Hey, Karen, let me interject something for you, and you got more to talk about on this graph. There was we picked up a few clients from there's a manager that took people out of the market
In mass.
in during COVID. Well, to your point, in 3 weeks in March of 2020 was the fastest decrease in the market ever. Faster and worse than 1929. But guess what? April was the best April in 30 years.
Yeah.
So that proves your point.
Right.
So if you jump out of the market, a lot of times the worst days are followed by the best days. If you've been looking at the market over the last 3 months, a lot of Mondays have been bad. But then look at Tuesday or Wednesday. You might have a Monday and Tuesday are bad, but then Wednesday, I had someone say to me, how can the market be 700 down on Monday and then 800 up on Tuesday? How can that be? Well, guess what? If you took your money out when it went down 700, what happens?
Well, you lost the upswing.
That's called being whipsawed.
Yeah, and that's really what we're talking about. We want to learn from the past. We know that the market's cyclical. We know events like this makes people kind of jittery and nervous, but you've got to look at the long haul. And in the long run, you are best to stay in the market. We are all hoping that what's going on right now is not going to be a 2-year recovery like, it was in 2000, 2001. We're all hoping that is not the case because a significant portion of our clients are within range of retiring. So you need to call us for special ways to look at how age gets into this. But what we're really saying is stay the course, have a good plan.
Yeah, and Karen, we said it on our radio shows before that we like to see if your bills are $6,000 or $7,000, whatever they are per month, we like to see enough guaranteed income to meet those bills. That way, when the market is volatile, you don't have to freak out. And let me tell you how we do that. Sometimes we might use annuities, guaranteed income annuities that might pay you $1,000, $2,000, or even $3,000 a month to supplement your Social Security, your pensions, and your rental income. And so you never have to worry or freak out when the market goes down. Now, if you're taking all of your money out of your stock market account while it's going down and you're retired without the big paycheck, that's not good. So, anyway, that's all we've got on this topic.
Well, yeah. So, again, just to wrap it up, you want to pay attention to your overall financial plan. You do want to have a stock market strategy in place. It should include rebalancing. You should reaffirm that your goals haven't changed. You should take a look at your risk profile. And if you're concerned at all about market volatility and how it might affect your financial future, we'd be happy to talk to you. We don't often give our phone number out on the podcast. I don't know why, but we should. So call us at 877-KPC-PLAN or go to our website, kpcfinancialsolutions.com, if you've got questions about how this volatility that's happening right now could affect your overall plan. So, hey, thanks for listening, and we look forward to talking to you next week. This is Kevin and Karen Christ with the KPC Smart Money Podcast.
You've been listening to the KPC Smart Money Podcast with Kevin and Karen Christ. To listen to more episodes, visit kpcsmartmoney.com. You can also find the KPC Smart Money Podcast on Apple Podcasts, Google Play, Spotify, and Stitcher.
KPC Financial Solutions is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through KPC Financial Solutions, LLC, a registered investment company. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should be construed as advice designed to meet the particular needs of an individual's situation. KPC Financial Solutions is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by KPC Financial Solutions. Hypothetical examples have been provided for illustrative purposes only. It does not represent a real-life scenario and should not be construed as advice designed to meet the particular needs of an individual's situation.